trading is the frequency of trading strategy. We have low frequency trading, generally refer to any strategy frequency trading, like it's going to be days, maybe sometime half a day or maybe like for couple frequency trading. Uh, and we also have high frequency trading strategy, which hold asset intraday. Ultra high frequency trading refers to strategy that holds asset on the order of second and millisecond. So just like hello, yeah. So right, like for any some kind of model. So first we have to look into that data, right? Like this, we should have some different source of data, which can be real time market data, which can be historical data or related data, news sentiments. We synthesize those data and like we come across with definitely we require collecting collection of new data sets where different analytics firms like which provides there are some predictive and indicators are also allowed that. Secondly, right, like we also require market itself, investment bank, instrument, and so we have to look into that how market keeps moving here and there, and we keep our finger on the pulse of the market. That is very important for building any trading strategy and understand the market. Thirdly, uh, third important part things so we have to look into that like global pattern. Sometimes like history may not repeat, but it certainly gives some kind of hint, some kind of opportunity. We have to keep looking into that. Fourth, we like analogies like some of the best traders try to think right like maybe this will work because of some market moving in that direction or other direction. So some kind of a gut feeling has to work. Feels like definitely anyone who want to build a trading strategies has their eyes and ears open all the times. Like this market, this world is moving dramatically, right? So definitely like for trading strategies, we have to use a lot of different tools like Mathematica, MATLAB, Python. Could you just advantage and disadvantage quantitative trade? So just like I have to move very fast into that. The advantage minimize emotions, right? Like automated trading system. Sometimes we don't require emotions to work into that, whether to do go with the our emotions to execute the trades or not. Like we have to make a decision in very split of seconds or split of my microseconds, you can say. So sometimes emotion definitely we don't have to play around with the emotion algorithms help into that. We have like some of the back testings, like some of the trading rules, historical data will determine this whether like a model is going to work or not. It gives a lot of idea about that, whether it allows for some profitabilities or not. Preserve disciplines because trading rules are established and trading execution is performed automatically. So this this gives us like okay, this is going to work, then this is going to work. We also achieve consistency. I mean to say, whenever we have to plan for any trading, yes, biggest challenge for trading is to plan the trade and execute the trade, right? Like so, we have to first, whenever we do the back testing, we have to understand whether this strategy is going to be profitable or not. Traders who ignore the rules are altering any expectancy of the system we having or not, right? Like so, definitely we have to go with some kind of consistency and quantitative trading provides. We sometimes like algorithm trading, high frequency trading, we have to send the data in very quick time, right? Like so, order entry speed, performance that also matters a lot. So that definitely we're going to provide or we achieve using this quantitative trading mechanism, we can say, that we can go. We have to connect with a different market, different account, different products, and have this price and positions availabilities based on a lot of strategy runs. So yes, like there are diverse. We have this. There are multiple possibilities where we can diversify the trading. Time and talent. We definitely time plays a very crucial role whenever we execute the trade, and talent important, right? Like everything goes back, like how much you are skilled, moreover, like how much you're knowledgeable about this dynamic risk management. Position sizing can also be automated system can respond not possible by any human being. So definitely, like it is all like using the machines. This is all about disadvantage. Like definitely managing the systems. It like the expenses, managing the multiple source of data. It's we have to invest a lot into that. In systems are always above the average. Mechanical failure this gives like systematic risk kind of issues, right? Like because everything it is done by machines, and if has not been proper monitor, or we don't put this in circuit breaker in case of any failure. So such kind of failures can get cascaded to this, like where possibilities of loss will be very huge. I mean, to say possibility of loss will be huge, and it can cascade to from one market to another market. We have seen multiple cases where some market crashes because of this sort of uh, trading. I already mentioned monitoring is very important for that. We have to look for that, right? Like how this market are sales guidance and managing the balance sheet, how exactly like a discrepancy in this between theoretical tradings or testing and the real trading gonna work as we are expecting. So right, like so monitoring is always important. There are a lot of mechanical failures also happens in the process. Sometimes we are executing trades and trades are not being established end exchanges. Sometimes we focus a lot of, into the over optimizations, and this is quantitative tradings are kind of like a race. It's going always going with the speed and executions based on the time. So right, like it's ongoing process. It does not mean like today you are making money. This is some strategy all the time. So that's like an important thing. Like you have to fine tune your strategies, fine tune your trade knowledge, and go with this like whatever. It's just like a race. So like you always have to skill yourself forever. So I put some this link here, right? Interesting link, like what there are multiple flavors of quant investing, investment strategies. Multiple guys are using how like quant hedge funds sometimes making a lot of money, sometimes not making money. So yes, like, we have to look into that. What I can say, right, like as a quantitative finance market overview, quantitative finance is roughly more than almost like more than 1 trillion market at the moment. And one of the report like CAGR report, which is telling like algorithm trading is growing at 10.3%. And right, like this is like one of the report. It will be continuing. The growth rate will be continued till 2020. Six of the top 10 hedge fund based on performance are quant funds. Most of those are quant funds in commodity market. It's just like we have different market, right? Like equities, then options, derivatives. You can say is for future. Then commodities market. We have fixed income market, cash equities. So we have multiple options like do the trading. One of the things is forex trading also. right? Like I forgot to mention, and roughly 90% of volume in the public equity market is traded algorithmically, 50% of volume. So you can assume, right, like how this this algorithmic tradings are being adopted by multiple firms, right? Uh, this like the increase of this the algorithmic trading across is like a phenomenon. That's what I can say. Anything you need to write down because this theoretical things, right? All right. Uh, quickly going with the different component of quantitative trading, definitely like few steps we have already mentioned about that. One of them is like strategy identification, strategy backtesting, systems, and risk management. These are four important arms of quantitative trading. So any quantitative trading process should begin with a research. The research process encompasses finding a strategy, seeing whether a strategy fits into a portfolio of other strategy you might be running, obtaining any new data necessary to test the strategy, and trying to optimize the strategy for higher returns or lowering the risk. So this is something like yeah, you will need to factor in your capital requirement and running the strategy as a retail or as a corporate traders, right? Definitely always reflect the strategy. So I mean to say it's like you have to find I mean to say how any strategy is going to be profitable, right? There are multiple ways you can try it out. There are multiple places you have to look into strategy ideas. Some of them are like social science research network, RC, seeking alpha, elite traders, nuclear finance, quantity. There are few other places there are multiple different strategies, quantitative strategies. You can look into that and define, right, like what could be the best strategy for you. And many of the strategy will look at will fall into categories, right? Mostly if you look into that, many strategies fall into categories of mean reversion, trend following, momentums. So these are few particular strategies are very popular. So once like you define your strategies, next is like you have to test your strategy. That is where the strategy back testings are needed, and it requires a lot of data, with definitely historical data out or maybe out of sample data. This sets the expectation how strategy may perform in the real world. Sometimes whatever this result you have bring into using your back testing, maybe it's giving very good result, it might not be working as correctly in the real market because of numerous biases, right? Sometimes they say, I mean to say like multiple biases, look ahead bias, survivorship bias, and optimization bias. Those are right, like or data snooping bias. Those are something which play around. You need to understand. Definitely, I can't discuss at this moment in time. Maybe if in another uh, session, something we can look into that. But these are we have to look into that, like kind of quality of data we have, kind of a different bias we have. We have to we have to work out into that. Sometimes the back testing results are not something it will work in this real world. So right, what I say, there are three things for any kind of data. We have to look into accuracy, survivorship, corporate actions, like how your corporate world things are moving across, and news sentiment also works for any kind of strategy. So that might change this whole equation itself, the kind of profit you are making. So in order to carry out a backtest procedure, it is necessary to use a software platform. You have you should have like some dedicated backtesting software. There are multiples in the market as well, right? You can also use your own programming language like Python or C++ or maybe Excel or MATLAB. But yes, there are multiple platforms available in the market. You can also use that. And using the back testing, you will be able to quantify how well it is performing. So that will give you an indicator. So this is what I can say. There are also a few things I would like to mention. Whenever you come with the back testing, so the few factors you have to look into that. One of them is maximum drawdown, which is good indicator for future drawdown performance of strategy. The second measurement is the Sharpe ratio, which the access return divided by standard deviation on those access returns. So, so access returns refer to the return of the strategy above a predefined benchmark, such as S&P 500 or 3-month Treasury bills. And yes, like those can help to define whether your strategies are good or not, like how it is performing. So, yes, you have to take care of that. Thirdly is the execution systems. Sometimes we talk a lot about ultra low latency system, high frequencies trading systems, and it's required multiple levels of implementation like co-located server, high-end servers, the cable like optical networks, the kind of kernels, so kernel bypass mechanism. The application itself will take care of whatever the implementation will take care of managing this almost low latency system, distributed data servers. So I mean to say, managing the whole execution system for that requires it's a complex engineering mechanism you have to apply for that, because execution system plays a role and also do a lot of automation processing. So, so yes, about execution systems, definitely I have worked a lot into building a routine system. Maybe then another session I will take it into that, how what exactly we have to do in order to make this low latencies or high frequency trading systems. What the science behind it. The fourth important thing is yes, like risk management. This is final piece of quantitative trading puzzle. Is the process of risk management. This includes all managing the all previous biases, what we have taken into consideration during the back testing, and maybe something else understand the pulse of the market, understand how things going on. They also involve technology risk. Uh, this how this technology is, it's a lot of things are changing, right? Multiple things about the technologies. It's completely changeovers, right? Kind of networking, kind of operating systems, or server levels, kind of uh, uh, the kind of messaging middlewares. We have to look into that also. Uh, we also look into that brokerage risk, such as the brokers may become bankrupt. So I mean to say, risk management is very key component, and sometimes it deals with a lot of other aspects psychology, profile of an investor, or maybe a lot of things. So that also one has to take into account. Uh, Until right, I just need to get some feedback, right? How if I'm going right. Uh, I mean to say, is I'm difficult to understand, right? So far not getting any feedback. no
Yeah, for me
question.
that is all good. And if anyone has any question, like they can unmute
Hey,
themselves
hey,
and
Prem,
So,
ask
I
the question.
understand your word of this quantitative trading.
this
And
Your
are
voice
we
is not
going
audible.
to
Can you be little louder?
I'm
really understand that what is the
just
strategy
speaking.
identification, how we are going to do it?
Looks like there was some issue. Pankaj, like your voice is not coming, so I have put you on mute. Uh, you can type your questions on chat. That would be better, I guess. If anyone has any question, they can just type in on the chat, and then Varun can take it up.
Trading strategy, right? Like it's very like it's going to be multi-hour sessions. We have to look into that, and we have to bring this chapter step by steps. Like definitely jumping into strategy straightforward may be difficult, right? Like, so this is initially this introductory session, and probably we going forward we will take more session into that the different trading strategies, how we are building, how we are what kind of data, how like the systems itself, the session, like how entry and exit signals we are going to manage, like maybe we use some kind of programming interesting things. But currently, I'm going to with the introduction of about the quantitative trading. So, right, going forward, definitely we will take more. Uh, I mean to say sessions. Maybe someone else from you can take those sessions on that. All right, perfect. So, right, like just try to bring this kind of pictures, right? Like there are, it's all about trading process and trading types, right? You can see there are markets, there are algorithmic trading, structured access. We have buy side and sell side, right? Like that is very important to understand what is the buy side and what is the sell side. Before that, we have some professional who run corporations or maybe institutions like JP Morgans or maybe you can say bank BNY Mellons or you can say it's so like and what exactly does like it just try to raise money by selling the securities. Why it is has been named the sales side. Sales side mostly it's with bank advisory firms or other firms that facilitate the selling of security on behalf of their client. This is what we say sales side, and buy side is for the capital market on the buy side, right? We have professional investors that have money or capital to buy security like any hedge fund, and these security can include you can say equities or share, preferred share, bond derivatives, or variety of other product like interest rate swap or like multiple things, and that are issued by sales side. So this is like buy side and sell side, right? Like mostly how it has been differentiated. And just like we have the portfolio manager, which manage the portfolios defined like based on different securities and risk, right? Like how we are going to allocate different kind of trading executions going forward. And on the top of that, we have ideas like definitely some researchers has to bring the ideas. We have some kind of in-house trading systems where they do the pro trade analysis. Mostly order management system do that, broker selections and executions, and it goes through multiple channels like algorithmic trading or direct market access, directly connect the chain, and yes, sponsored access. There are also the sales side also do this trading like in the proprietary trading system or systematic trading by which I was part of that. Like they also used to do trading for using their own money. Yes, and sorry, there are also different trading types here. I'm sorry. Trading types. I'm bringing into that, right? Like we have quantitative investors, hedge fund, institutional investors, hedge fund. We have some kind of overlap between like portfolio program trading, systematic trading between buy side or between the quantitative trading, high frequency trading, statistical arbitrage. So I will cover like in this slide like algorithm trading, overview of algorithmic trading, and high frequency trading and and statistical arbitrage. And these are right like multiple uh, direct market access, manual trading, and algorithmic trading. So yes, like this is how like differentiate among buy side, sell side, and algorithmic what we have talked about high frequency trading or statistical arbitrage, right? Like those are a subset of algorithmic trading. Algorithmic trading is the process of using computers program to follow a defined set of instructions for placing a trade in order to generate profit at a speed and frequency that is impossible for a human trader. Definitely, like this is what mean by algorithmic trading. Like you have to use some trading rules that has to be executed by your systems, and like speed and frequencies matter most for that. So timing, price, quantity, or any mathematical models like what we need for executing algorithmic trading. And why algorithmic trading, right? Like we have discussed a lot into that. Like apart from profit opportunity for the traders, algo trading also makes market more liquid and make trading more systematic by ruling out emotional human aspect and trading. I mean to say is uh, executing or executing different trading activities. So turn out to be a systematic trading, right? Like that's how they say. And algorithmic trading provides uh, multiple benefits as a executed at the best possible price, can be instant and like accurate trade order placement, trade time correctly, instantly reduce transaction costs and automated checks on multiple markets. So like how fast you can connect and you find like some kind of arbitrage opportunities, or like you define your trend, or you find it like based on your own instinct. Like definitely you can execute the trades with best possible way, and ultimate goal is to make as much profit as possible, right? Like so algo trading is used in many forms of trading and investment activities, like mid to long term investor to or buy side firms, we can say pension fund, mutual fund, insurance company, who generally purchase stock in large quantity but do not want to influence stock prices with discrete large volume investment. There are short term traders and sell side participants, and definitely right, like it means to create sufficient liquidities in the market. There are some systematic traders, which are mostly trend followers, pair trading, hedge fund, find it find it much more efficient to program their trading rules and let the program trade automatically. So yes, like this is how markets are defined for algo trading. Like I also put some kind of examples, right? Like medium to long term trend following, equity, statistical arbitrage, option arbitrage, volatility. Sorry, like there is spelling mistake in that. Like volatility arbitrage, volume weighted average price, time weighted average price, percent of volume, volatility trading, social media trading. trading and market making, dark pool of equity. So those are some kind of examples of that. Sorry, like this seems like there are some minor spelling mistakes are there. Just pardon me for that. I think I've done it very quickly on the building this slide. So right, like if you allow me few moments, if I'm not exceeding the time, like I would like to go each of these things, right, like very quickly into that. Yes, like if we talk about CTA, right, it trades a large number of underlying volatility or virtually all asset classes with some trading signals derived from daily price inputs like in intraday how we define like any trading signals we get it like we do this some of the things are like moving average, channel breakout, price level movement, and yeah, like multiple technical indicator like zigzag indicators could be one of them, and they are very simple and easy strategy. Sometimes they say like some long or short strategy that makes a lot of money in the market compared to any other complex strategy. So this is what like people's perceptions. Maybe they make money, sometimes they lose money as well. Equity statistical arbitrage, like, I believe it like while I was working with trade, so it's like they were making a lot of money in the strategy. This is mostly high frequency trading models, continuously look for short term price discrepancy in various stock market around the globe, and they try to find opportunity as soon as like there any kind of bid or ask spread they find it, they just execute with a large volume of trades and in this very quick times, and that is like ultra low latency systems will be required for that. So definitely some intelligent order executions has to do that, and also we try to minimize market slippage. This is what like equity statisticals arbitrage strategy about arbitrage is mostly deal with a large number of options listed and over the counters. Like this is what like I mean this is mostly strategies they try to bring into the strangle, straddle, butterflies. Those are the strategies are very definitely complex, but like option arbitrage traders mostly use that. Index arbitrage, like I think that is also one of the key things. Like they try to make a profit from the difference between actuals and theoretical future price of the same stock index. So this is what exactly they do it simultaneously buying a stock index future while selling the I mean to say while selling the stock in that index. So same times buy and sales, and this is what like have to be or has to be executed using some program trading. So what exactly software monitors both stock index and future contract on the index, and whenever any opportunities comes up it being notified, and like yes, some of the popular indexes S&P 500, Vanguard 500 index fund, Fidelity is Spartan, Fidelity Spartan 500 index are few of these examples I can say. There's another arbitrage, interesting arbitrage, a volatility arbitrage. It's that try to exploit the difference between forecasted future volatility of any security and implied volatility of options. Mostly Black-Scholes equations we use for that, defining the implied volatility. Maybe sometime we can discuss on that what exactly Black-Scholes equation, how we come up with this computation of that. Uh, yes, like options pricing mostly determined by the volatility of the underlying assets, and if forecasted and implied volatilities differ, if there will be a discrepancy between the expected price of options and its actual market price. Like so, definitely like it can be in cash using some program trading. Volatility arbitrage strategy is generally implemented through delta neutral, sometimes vega neutral portfolio also. So this is about volatilities, arbitrage. Quickly go through that weighted average price. This is a strategy breaks up the larger order and release dynamically determining the smaller chunks of order to the market using stock specific historical volume profile. So idea is to execute the order close to the volume weighted average price. So this is what uh, I mean to say any trader try to do in terms of make the profit. There's another similar kind of strategies you can try it out like time weighted average price. So it breaks up the large order and release dynamically again in this timely fashion. So so it divide this between the start and end times and try to define like based on historical prices like what will be the time weighted average price and execute the order close to the average price between the start and the end time. So this is one of the strategies definitely I never tried this one maybe but this could be one of the strategy. Another important percentage of volume right until the trade order is fulfilled and the algorithm continues running, keep sending the partial orders according to defined participation ratios and according to volumes traded in the market. So this is all about a percentage of volume. Maybe we can discuss further on that. Yes, there are other things are there. Volatility is trading is composed of several service strategies with varying complexity and trade frequencies. Social media trading, this is also one of the proprietary algorithm which allow to mine or get this information from the web and social media about them. It's all about getting the information and predict the security pricing. Yes, market making, I believe everyone understand that, right? This client engage in selective market making on number of exchanges and instrument by using proprietary pricing models. It's all about defining the a, a sophisticated risk management systems, and it allows monitoring of or the or looking into the exposure level over the instrument type, currency, account, and portfolio. So quickly, you have to go with the dark pool of liquidity. I believe like a lot of discussion happened whether it's uh, ethical. Hi Gaurav, is this still the problem? Okay, it seems like someone having this, someone unable to hear me. I really don't know, right? We still have 10 minutes left. Let me try to close these things.
But
Uh,
I think you, it's not a problem from your side. Gaurav is having problem because he hasn't joined the audio. I think same problem Kinjal also faced. So let me ping him. Okay, so you continue.
All right. So dark pool of liquidities, like a lot of discussion happen, like whether it's ethical trading or not, and it is like private stock changes. Mostly, Credit Suisse made a lot of money using that dark pool of liquidities. It's like private stock changes for trading large block of securities, and public won't. Or public who are or doing this normal trading in the market won't know about that. So this is all about this private trading exchanges are called the dark because of completely lack of transparency, which benefit the big player all Credit Suisse. I can name it. I definitely I know about that. Deutsche Bank, I don't know has tried it or not, but Goldman Sachs also have done a lot of dark pool of liquidities or uh, you can say private stock changes trading. So a lot of discussion happened should we have or should we won't have, maybe sometime we can discuss on that. So definitely it helps with big institutions compared to market efficient normal traders definitely won't get or have a lot of losses because of that. So, right, quickly I have to go through that. I think I already have mentioned some aspect of high frequency trading. It's another subset of algorithmic trading. And the idea is of high frequency trading. I think I mentioned about that, like sending this large number of small transaction of all trades as originating from high frequency trading system. It has to use the highly sophisticated computer programs to place the order, and often in the market across the different exchanges. So low latencies and high throughput system definitely affects more number of trades uh, can be executed or transacted the same time, and also it has to connect or it has to be executed at different exchanges. So this is all about the high frequency trading. It's very complex, definitely only large institutional investor or who build this such kind of high frequency trading systems, like hedge fund who really build a system like that, and they do go with this such kind of trading. And high frequency trading is another form of automated trading, and requires algorithms, low latency technology, high speed connection to market, and high message rate. So these are something for it's essence of any high frequency trading system. And in recent, high frequency trading has grown substantially over the past 10 to 20 years. It now accounts for 55% of trading volume in US itself, in US equity market, and moreover, more than 40% in European equity market. So, right, there are a lot of opportunities definitely in the high frequency trading system. So some of the strategies are known as passive high frequency trading strategies. Some of them are uh, aggressive high frequency trading strategies. Some of them are arbitrage trading strategy. So those are something we have to look into that. And purpose of high frequency trading, right, provide the liquidity by matching buyer and seller orders, or by buying and selling through its own security inventories. So this is what the uh, all about the high frequency trading strategy, how exactly we have to build that. So market making is is the one of this market makers are one of them high frequency trading strategies as well. So, right, I already mentioned, arbitrage trading, find this price difference between different exchange traded fund, or all different exchange, right, where this they can do the transaction underlying this different. I mean to say it's going to be stock or bond or commodities. They have to they are trading. So, quickly go through about this aggressive hyperkinetic trading strategy. So, momentum ignition is one of the strategies. Mostly proprietary trading firms execute. It's a series of orders or trading aimed at causing rapid up and down securities. So, momentum ignition is the name of the one of the strategies, right? What I know, this is makes uh, mm, uh, right makes lots of profit, but it's also cause, right, a lot of issues, like fast crash, right, one of the very uh, biggest risk of this financial systems. There was I think in the year July 2011, one of the flash crash happened to this, or maybe it's in May 2010, there was a flash crash happened because of high frequency trading systems. That is systematic risk. There was direct 5% to 6% plunge happened to the market, and definitely it rebound afterwards sometimes, but yes, in a span of few minutes, uh, they're almost like Dow Jones plunge almost 1,000 points on a intraday basis. So yes, so hello. Yeah. So, right, benefits and risk I already have mentioned on that. Benefit lower the transaction cost, tighten bid-ask spread because it goes with this minimum this bid-ask spread and execute with a large number of or large volume of trades. It increases the market liquidity. There are more market opportunities and enhance the market efficiencies. Risk already mentioned about the systematic risk, flash crash, some of the things like which propagate from one market to another market, right? Like some algorithm may goes wrong, like it cause big loss. There are many hedge fund or big banks also have experience before. It also caused a lot of volatility in the market, and sometimes like people has to know, right, can question on that, like such kind of tradings are ethical or not. So those are something definitely uh, exchange, US security exchange, they come with a lot of I mean to say it's compliance into that. One of them is Volcker rules, Dodd and Frank, and this Basel. There are multiple compliance has put into place for that. So characteristic already mentioned about that: large in size and scope, co-located server, direct market access, large share of message traffic, quick reaction to market information. So those are the characteristic of high frequency trading, and there could be high rate of orders, execution, new orders, cancel order modifications, high volume of trading executions. There are very minimal margin between bid and ask, and sometimes orders can be traded passively using the algo trading system. Yeah, this is all about the high frequency trading, and quickly has to go through that with statistical arbitrage. I think I already have crossed this time limit, but yes, I will try to go through in this quick round about the statistical arbitrage. It's from this very hugely profitable algorithmic trading strategy for many big investment banks, including Credit Suisse I have worked for, and many hedge fund like Millennium Hedge Fund. They also do a lot of statistical arbitrage, and like this is originally we bring to this or the originator of the statistical arbitrage itself is led by Morgan Stanley in year 1980s, and yeah, right, till from there, the popularity of strategies continued. Like this is still ongoing, and one of this like fancy, it could be pair trading, right? That we can also name it statistical arbitrage as a pair trading, where the buying and selling of a pair of stock based on their relationship with each other. So what we exactly we have to look into that, like how this one two pairs are correlated to each other, and how this one stocks in a pair outperform to other. Like this is one of this stock may be performing high, or one of the stock may be outperforming the others. So something like we have to look into that. The positions we have to hedge from the market changes movement by shorting the, like one has to be long and other has to be short, and so the large number of stocks involved into this statistical arbitrage. uh, the high portfolio turnover and fairly small size of bid and ask spread, right? Like this is what statistical arbitrage. And whenever any or when we look into the market, the crux in identifying such opportunities lying mostly using two main factors. First, you have to correlate between the pairs. Definitely, some kind of mathematical computations are involved. Those are statistical, like standard deviation, mean variance, as well as the correlated factors, correlations or co-integrations factors. We bring into that. We define which of the pairs, which definitely we have to analyze with the time series historical data and statistical test, and then specify the entry and exit point for the strategies, right? Like wo- among the pairs which are outperforming each other, and then we have to build this strategy on top of that. So different concepts by statistical arbitrage strategy include time series analysis, auto regression, co-integration, volatility modeling, principal component analysis, pattern finding technique, machine learning techniques, and efficient frontier analysis. So those are something we can discuss in a later part of some other session. Definitely very interesting, and it involves a lot of math and statistical analysis. So the type of statistical arbitrage strategies I already mentioned is four of them are there. Market neutrals arbitrage, cross asset arbitrage, cross market arbitrage, exchange traded fund arbitrage. So something like these are just like finding the opportunities, right? Like using different strategies. So yeah, right. Like this very last thing about this risk in statistical arbitrage. So it is very much dependent on like it's just like pair, mostly like it comes as a pair trading, and heavily dependent on mean reversion of the price to their historical and predicted normal. Sometimes outcomes may not be as like whatever we have done or we got the result doing the back testing, and the profit from arbitrage model can't be guaranteed, right? Like because financial markets are always evolving and markets are getting more efficient. So sometimes like profit margin always cut downs. Like so, yes, this is all about the statistical arbitrage. Like it's very very interesting things like to go into depth and understand that, and probably like sometimes later like some of you may go or take through with this kind of topics, and I personally like very much like this statistical arbitrage. All right, so almost end of the sessions. So I have put some this interesting read. If you have time and you can, anyone have these books on this in the list or something like we can share to each other, very interesting book, or anyone can buy and read it if you want to have understanding about this quantitative tradings, about this from the beginner to this end. Like definitely I find it like these are books like maybe give you good overview, good understandings, and maybe you can start interest and start doing the trading and making profit, even for yourself or for your company. Thank you very much. I would love to have more question. I want to take it more question on that. Uh, just like sorry, like there are some kind of issues with the systems, the audio qualities and something like that. My sincere apology for that. We'll have to look into that, right? How we can make this session more interactive and uh, yeah. So one
Thank
of
you,
the
Varun.
questions, yeah,
Yeah, thank you, Varun, for your time. And I think there is one question from Zoe, like maybe you can take up. It's on the chat.
yeah. Is it possible to build all this infra at home as a retail trader? Someone want to try this quant trading stuff. It's possible to get the infra. Definitely yes. Like nowadays machines are like I mean to say it's very efficient, and like I myself do the tradings like trade workstations. Sometimes I do it, but yes, not very. I'm not very active into that. Uh, but yes, like it's very much possible. Many guys are doing. Many of my friends are doing the trading sitting at home. Even sometimes they execute using their phone itself. So just like I believe MetaTrader, Ninja Trader, there are multiple systems are available in the market where you can have your own account and start doing this trading itself.
Cool. Anyone has any other question? Like they can just chat, and then if there is no question, we can just close the call. Just
I would also would like to know the some feedback, right? Like because definitely I find it like there must be some means to interact, right? Like it's going to be all through and I mean to say like it's no, it's because most of the time I was talking, and I would love to have other and talking as well. Sometimes yes, like maybe we would like to have more time for such kind of session, and it's all interacts. If we try to make it more interactive, right? Like probably it will make more meaningful.
Correct, correct. I think like there was some issue with the voice, though that's why we couldn't make it interactive. Maybe like I will try to find some other tool which can provide more interaction and quality of the audio is even better. So yeah, I will try to find out some tool.
There's
And
another thing, Anshul, right? That I would like to understand like who else are willing to contribute toward such kind of session, right? Like
yeah,
I
there are
want to.
many. There are many. Like I
There are
will share
many.
the yeah, yeah. There are many people who are willing to share their knowledge.
Wonderful.
Yeah, and couple of them I have already talked, and I'm on the like verge of finalizing the topics, and will share the session details soon. And yeah, from your side, like you have been very cooperative, so I think like you will have more sessions in future, and we can learn a lot from you.
Definitely yes. Like I believe that it's more sharing. Like this is the forum. Like we help each other. The purpose is we have to help each other. We have to make it as more like a family, and like we share our knowledge, and maybe like going forward we have to strengthen this forum into like a more bigger into more bigger way, right? Like we have to define it. We want more participation. Definitely, I love the ideas and many thanks. Like it's all your initiation. My sincere thanks
Uh,
to you.
Barun, this Venkatesh here. I just have a question.
Yes.
Varun, is this about when even commodity trading like derivatives is also involved in this training?
Definitely yes. It's not involved with any specific subject. I think Anshul can answer more into that. But yes, like I believe uh, it's all about this how much we can share our knowledge to each other. Purpose is that so could be commodities, could be like for future trading, and those are definitely interesting subjects. And yeah, Ansel, like you want to add it, like
Yeah,
definitely
yeah.
feel
So
free.
basically, this forum is just for like it's an open forum, and it's not limited to trading, because we will have some session on technology, some session on management, some session on some other topic where we have like subject matter experts. So basically, like it's not confined to any particular thing. So it's a like across everything like we can train, but only thing is
Okay,
like we
okay.
need more volunteer who can take these sessions. So couple of volunteers I already spoke. Like one is for .NET, and for that like some latest technologies like he will take. I will share you the topic details and the trainer details later. And another one is for management, and that guy is also like very senior guy, and we will have that session next week for sure, next weekend. And I don't want to keep anything on weekdays, because everybody is working, and then people who are interested might miss it. So that's why like I am keeping everything on weekends, so that like most of the people can join. So like for example, this session around 30 people registered, but turnout was a bit less, I guess. Maybe that will also improve in future.
So yeah, I think we need to promote as well, right? We need to market our whatever we are doing. The more good word we pass, right? Like definitely it will uh, raise this like the attention, the traction, the maybe right like so
Correct, correct.
probably we have to do that also.
Yeah, and the people who joined, they have to market as well.
Yes, definitely. And thanks for being joining this session.
Thank you
Definitely
all.
like
Yeah, thank you all. Have a great night. Bye bye.
bye. Take care,
Thanks.
everyone. Have a good night. Bye.